Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of ZANA Investments, Tim Little. And if you believe, like I did, that if you live somewhere expensive, you can't invest in your own backyard, then you need to listen to today's guest, Lior Rozhansky. Lior is the founder and president of Flora Capital, LLC, a multifamily investment company. He has years of experience in the multifamily investing space, with his first acquisition coming at the age of 23. Since then, he has built up a large multifamily portfolio with over 30 million of assets in Boston through strategic partnerships with capital partners. Along with multifamily investing, Lior has years of experience in the real estate brokerage space and runs one of the top firms in the Boston area. Lior, welcome to the show.
Thanks for having me. Excited to be on here.
Yeah, we're definitely great to have you. So I gave everyone a really high level overview there of your background, but on this show, we really like to get down into how you got started on your journey to multifamily millions. So please tell us a little bit more about yourself and what brought you into the multifamily space.
For sure. So I always kind of call myself a doctor, a real estate investor that used to be a doctor kind of deal. I kind of have a classic immigrant story where parents came over here to the States. My mom was in medicine, wanted me to go to medicine. So I went to school for that, applied to med schools out of college while I was doing a year in the corporate world. And then I basically, right as I was applying to med schools, got my first property under contract. It was a 3-family here, very close to Boston, within 10 minutes outside of downtown. And basically, right as I got that offer accepted, decided that, medicine was not for me. So since then, I've kind of been going right down the real estate space. Then about 8 months, left that corporate role. It was a management consulting, ended up buying a couple of development projects, got licensed, and kind of started tackling all different facets of the real estate space. And, within a few projects, really quickly realized that multifamily was the way to go. And have really since then been focusing on multifamily, buying holds. It's been for me, it's always been the right strategy.
So let's talk a little bit more about that first deal that you did, because I'm always curious as to how people get that first deal, because so many people just sit on the fence. They educate themselves, they listen to the podcast, they read the books. What was it about that deal? Just tell us a little bit more about that, and what got you interested in even thinking about that as an avenue in the first place?
Yeah, I mean, I can't say I had amazing logic back then. It was more of just, I actually had a couple of buddies that had contracting experience. They were talking about buying property, never really did it. And then I kind of just thought to myself, well, if they can think about doing it, I can probably do it, right? Can't be that hard. So that was kind of the basis for it. In terms of electing where to buy and everything, one thing I really quickly understood, and I think it's pivotal to me to this day, is I saw the changes that were going in the Boston market. I started driving around a lot of different neighborhoods and kind of really got a feel of like just the growth, the potential of a lot of these neighborhoods that, this was 2015 at the time, were just kind of going through the ripe of change. So that got me really excited. I ended up buying in a neighborhood that I'm still very high on today. I still have that first building. Since I bought that building, there's been multi, like even $1 billion projects. We had a casino get built since then. So I've always kind of been very focused on buying in areas that I thought had a lot of room, a lot of runway, while still having an established demand.
Okay, so would it be accurate to say even that first deal, you planned for a long-term hold on that one?
Yeah, I wasn't really looking to flip it or anything like that. For me, it was just, hey, let me buy it. I probably can't screw up if I hold on to it long enough. So let's see what happens over the long term.
No, that's good, because I think so many people, especially when they get started in real estate, they assume that they need to do flipping as kind of this stepping stone, as part of a natural progression. I don't know if it's influenced by cable TV or what, but it's interesting to hear that you already had a long-term perspective on it, and you were looking out 5, 10 years on that purchase, not just, hey, let's hold it, fix it for, the 12-month minimum so we avoid short-term capital gains and then take the money and run.
Yeah, exactly. Again, for me, I realized that I didn't really have intention of being a very high flipper operator. I ended up doing 2 flips after, just because, I got a little cocky at that point and thought I thought I had God's hands and couldn't mess anything up. And I quickly learned that wasn't the case. So that, after those two flips further reinforced to me the point that I should really stick to that long-term buy and hold. But yeah, since then, that's really been the crux. And I even speak to my lenders a lot at community banks here in Boston. They all tell me super rare for young people to understand the value of just holding on to property. Everyone comes to them for fix and flips. But, and they're always very surprised about just like that we just hold on to things. We don't like to sell. I've only sold one property. I really don't like to unload anything off of my portfolio.
Nice. And so you did dabble a bit, it sounds like, in the flipping. It didn't work out, but I think it's good because it reinforced what you already knew to be true. So where did you go from there in terms of that small property? You said it was a 3-family. I don't know if it was a triplex or if it was just okay. And so after that, what did you plan to progress towards, and what did you actually do?
Yeah, so I knew I really wanted to stay in the Boston area. As I was going through that process, I got licensed. I also started to really understand micro and macro, right, of each neighborhood, Boston as a whole. I certainly studied other markets and kind of understood the major advantages of investing in a market like Boston had. So I really wanted to stay there. So I ended up essentially progressing to do a higher volume of multifamily buy homes. Like most operators out there, pretty quickly I ran into a capital strand, right? At some point, you can't finance your own deals, or you can only take out so many owner-occupant loans. So I ended up partnering with actually my broker at the time, who had some experience. He's raised some capital before, had done some deals, and we started buying a lot of value add deals. And I would say probably, probably classified in kind of Class C areas around the Boston area. Even though those were technically quote unquote Class C, I still saw a lot of room for growth there, right? It wasn't like, it wasn't a stale market by any means. It was pockets of the city that were quickly and rapidly changing. So I really got excited by that idea. So we basically, over the course of 3-ish years, 4 years, bought a ton of buildings together, went through a lot of heavy lifts, a lot of construction, got rehabs, even did some ground up development.
I think there's a lot to take away from what you just talked about. So, first of all, I think what you're hitting at is you wanted to be an expert in your market, especially if you weren't going to look at other areas. If you were going to focus on your backyard, then you were going to know it block by block and know which areas had the greatest chance of improving.
Exactly. So that was the goal, right? As I was, and that was part of the advantage too of getting licensed in the market too, because I was really able to understand literally street by street, right? I mean, I knew which streets I wanted to hit, what streets I didn't want to hit, where there were, I knew where the developers were targeting some of the major projects, where there's going to be potential infrastructure projects. So I could really get ultra target. Brokers would send me deals, and within 30 seconds, I could tell them yes, no, and whether I was interested or not. So I just became incredibly good at understanding these areas. And that's the same logic I use today. I mean, today we've kind of progressed more, I would say, Class B and A locations in the Boston area. But same thing, right? I mean, I know most of these areas, I know street by street. I know exactly where the big projects are. I know, what areas the young professionals like, what they don't like, where I could potentially get Harvard kids, where I don't get Harvard kids. Like, I know the blocks in and out, and that's ultimately my, one of my biggest competitive advantages today as well.
Yeah, absolutely. And I think that's what a lot of investors, both those active and passive, don't think about enough is, we'll hear, oh, this is a hot area. Atlanta is a hot area. Miami is a hot area. Okay, well, what does that mean? That's often like saying that a large metro is a hot area is not necessarily enough. You really need to drill down and say, okay, what about that submarket? What does that look like? Is it in what I like to call the path of progress, right? Is it going to be turning around? If you're in a C class area, or if you have a C property, is it a C property in a B minus area to where you can bring it up to those local standards? Or is it a C property in a C minus area, in which case you're just putting good money over bad? So it's really all about that potential. And I think you recognize that.
Exactly. And, I've obviously within my team, we've talked about, do we expand into other markets? We've certainly had thoughts, right? I mean, I am incredibly high on Boston, and I think I'm going to continue to buy in Boston for as long as I'm an active investor. But we certainly had thoughts about, do we expand into other markets? And one of the, and you kind of brought it up, right? One of the things that I think is a little flawed in the industry is people will say, oh yeah, like, these metros have been booming, right? And, Atlanta, Dallas, the Carolinas, right? Florida, obviously. And when you have operators that are going into multiple, like 10 different markets, right? And they own one deal in 10 different markets. Well, can you really pick out the property that's going to be the winner, right? Because ultimately it's all about local demographics, right? So yeah, it's great to say that this city is doing well, but can you really pick that horse within the city that's really going to take you the furthest? And if you don't really know that market in and out, that's going to be tough for you, right? So when we do expand, which I know we will, we're going to play just as strategically, right? I mean, it's not going to be, hey, let's choose 5 different markets and expect and get one property in 5 different markets. It's going to be, hey, if we like Atlanta, all right, well, let's really look at Atlanta. What's going on in these different neighborhoods? Let's become real experts in Atlanta and really figure out exactly what's going on so we can really deploy our capital the best way rather than trying to do too many things at once.
Yeah, and I think that's really smart. I mean, besides grounding yourself in your backyard and becoming an expert on that area, you also have that competitive advantage that most people don't have the capital, or they're too scared to invest somewhere that expensive. They just don't have the resources to do so. So I think that also gives you a competitive advantage there. I know you don't shy away from heavy value add. You talked about a couple of different things, even going all the way to ground up, which is an area that I have not played yet. But why don't you explain to us what exactly constitutes a heavy value add, and what are some of the risks and rewards associated with that?
Yeah, it's a good question. So just to kind of step back, we've certainly, it's not like every project is a major heavy value add project. I mean, we've certainly done very, very light value add stuff, particularly as we play into the quote unquote more established areas, right? Like you kind of more class A markets around the city. But we've certainly done some very, very heavy lift projects, right? I mean, some of our projects today that we're actively doing are coming in at $80,000 to $100,000 per door, right? Or per unit. So these are pretty significant lifts, right? Where we're doing kitchens, baths, floors, electrical, plumbing, maybe sometimes a little reframing. So it kind of depends on the project, but we can certainly get into the nitty gritty of it. And obviously there's, construction comes with its own disadvantages and advantages. Boston is incredibly tricky area to do construction. It's also a very expensive market to do construction in. So a lot of it is budget management, making sure your budget doesn't blow up. Trying to keep costs within 10 to 15% of your original projections is a good way to do it. So we certainly don't shy away from it. I mean, even in kind of the nicer areas here where I've done some pretty heavy value add stuff. And again, the point, it's not like we look for it, right? But it's just when you identify properties that are in just amazing locations, a lot of inventory in Boston has been generationally owned, and it has been owned by the same families for 30 to 100 years at a time. So obviously you're buying a lot of dated product, but they're just in these outstanding locations, right? Like just outstanding locations. So you got to figure out, all right, well, we want to own this kind of inventory. We want to own this really indestructible real estate, in my perspective. So what do we need to do to kind of get it to today's standards? That's kind of where the magic happens.
Yeah, and I've definitely seen what you're talking about. When I lived in DC, for example, right? You have some of those older properties, places which were once very undesirable, 10 years later were very desirable and very expensive. And it's just amazing how fast some of those areas can gentrify, but it takes money to do that, right? Someone needs to go in there, buy those properties that haven't been, kept up with as they should have been, but they're beautiful all brick buildings that are going to last 100 years. You just need to put the money in to modernize them and make them what current renters want. So it sounds like that's a lot of what you're doing there too.
Exactly. Yeah. To give kind of like numbers and perspective, right? Today, in a lot of the areas that we're buying that are kind of the, dominant established markets that will, in my opinion, my humble opinion, will never be wiped out. What we're buying inventory at, say, $350 to $400, 350 to 400,000 per unit up front, and that's typically gets us kind of potentially old, crappy product, right? You're putting in, let's say, anywhere from $50 to $100,000 per door, but a lot of times you're pushing close to 550, 600, and even higher on the back end per unit on the stabilized base. The numbers are certainly bigger here. They're certainly, they're certainly a lot bigger, different than a lot of other markets in the country. But to me, I actually like that, right? I mean, I think it's a barrier to entry, right? So it's only, only really the best operators can compete here. I've done a lot of content on this myself where I really like investing in expensive product, right? Because to me, I would prefer to buy something that's very expensive rather than very cheap, right? Because I see it as durable. I see it as something that's stable. I see it as something that's going to continue to provide the demand where NOIs aren't going to, and they're not going to go anywhere, right? Over the next 5, 7, 10 years, right? So I see that as a fantastic long-term play that can really hold its value over many, many years.
Yeah, wow. Yeah. The numbers you're talking about are 3 to 4 times what a lot of the properties that I'm looking at in the Southeast. So it's just amazing to hear those numbers. But I mean, if the math works, the math works, and that's all that really matters. I guess I would just wonder, do you run into challenges with lending or raising capital just because you have to raise so much more, looking at the cost, both the cost of purchase and the capex, the cost to renovate?
Yeah, I mean, from a lending perspective, not really. Most of our debt here is we get through community banks who are very, very much in the loop of exactly what it takes to be an operator here. So they understand the challenges, they understand the numbers, they know, they get the cost of construction. So I would say lending is not necessarily a barrier. And in fact, a lot of community banks here are really fantastic partners. Even on bigger acquisitions, I mean, we get really, really attractive debt that you might see close to on the agency side. We're getting a lot of 18, 24 month IOs, getting fantastic LTVs, 75 on the acquisitions. The difference is kind of like bridge financing. They'll finance 100% of the construction typically, and they'll do what's called like temp to perm loans, right? So we don't necessarily have to refinance. It's a lot less risky than a bridge loan. We can sit on this debt if we want to, we can refi if we want to, right? It kind of gives us that nice flexibility. And then in terms of raising capital, I would say also not, right? Because I think a lot of, every capital investor needs to have balance in their portfolio, right? And there are certainly times where investors that need more cash flow and want that extra income coming in and kind of really squeeze that cash on cash return, for example. And that's perfectly fine. And we certainly have opportunities like that maybe we're going into kind of those Class B, maybe Class B markets or anything like that where we can kind of really squeeze yield. But if we're kind of playing into these higher end markets, we actually get a lot of interest, right? Because a lot of people understand like, hey, we're buying property within a mile of, for example, of Harvard University or MIT, right? Or MGH and Dana-Farber, right? I mean, we've got incredibly stable demand here. I mean, we've got almost every industry in Boston. So people understand the value of being invested in some of these neighborhoods and they get excited about it, right? I mean, that's truly what I call indestructible long-term wealth, right? Is, investing in something that isn't going away, no matter whether it's COVID or whatever else comes in the future, like this stuff is here, right? And it's not going anywhere.
Yeah, that makes a lot of sense. So it's almost like this legacy that surrounds Boston itself. There's something in there that I wanted to pull out because I think it's a super key point for listeners to understand. You talked about this relationship with your community banks and how that allows you to get these flexible, favorable terms to do these deals within Boston. And what I want people to understand is that's usually, I'll say, only possible in that area, right? Like to do locally. I can't, as a Tampa-based guy, go to an Oklahoma local bank and say, I want to do this deal, this, that, the other, because they will view me as an outsider. So it's really comes from developing those relationships locally. And again, another competitive advantage for you, it's restrictive on one side because you can't do that everywhere. But at the same time, for the market that you're working in, I think it's also a huge advantage. And it's important for people to understand that, like, hey, if they have a market in their backyard that they can work through, one of those key relationships is those community banks. And I think that often gets overlooked because people just start looking at these huge lenders because they can work everywhere, right? But these local banks have so much more flexibility in terms of the terms and rates and everything else that they can give you because it's their money. So please, I would just tell the listeners to not discount that point.
Yeah, and I would just say particular too, if you're doing value add project, if you're buying turnkey product that's close to 100% stabilized, maybe you do go look at some of the big lenders out there, right? Because there's not that much as much creativity necessarily. But if you're going to start looking at value add projects, I mean, the advantage is a lot of these lenders, they get it, right? I mean, they understand like, oh, you're going into this neighborhood. Okay, we understand what you're trying to do here. You're trying to finish extra space here, or you're trying to do this kind of improvement there. Like they understand your business plan to a core, right? Whereas, you bring in a national lender, to them, 1 part of Boston versus a mile down south of Boston is the same, right? I mean, they don't care. It's Boston, right? They're not necessarily going to have that real local flexibility and understanding of like, hey, these guys discovered like a true gem in the marketplace. This is how they're going to really extract all the value. Let's help them out.
Yeah, and for you, I think an advantage too is that sanity check, right? Because they know the market just as well as you do. They're going to look at those numbers and they'll be like, this right here, you may be a little too aggressive, or on this, you may be a little too conservative. They know it well enough to actually do a legitimate check on what you're saying.
Exactly.
Yeah. Okay. So I know that we mentioned at the top of the show in your bio that you got started pretty young. Talk a little bit about that, and then let us know if you faced any challenges just in terms of people taking you seriously. And if so, how were you able to overcome that?
Yeah. I mean, I get asked that a lot. I don't think necessarily faced super hard challenges because of that, right? Directly. I mean, of course, when you're trying to raise money, people will obviously notice your age. I mean, you obviously take a lot of face-to-face meetings. But I think a lot of it is usually pretty set to bed when you start talking about partnerships, right? That was one of the things I've been very, very specific about. I've operated with a number of different partners, all bringing different sorts of experience to the table. That certainly helped me establish and set to bed any major concerns. As I've obviously continued to do more deals, and I've started to continue to leverage my own resume, right? Even being on the younger side, if we're delivering results, we're delivering results at the end of the day, right? I mean, there's not that much to it. And one thing I've told a lot of people is I told them like, hey, just because the fact that I'm young is actually a great advantage to me, right? Because I don't really have any other major responsibility, right? Like I don't have a family, don't have a wife, I don't need to do anything crazy. So I can really devote myself fully to this business and to the operation. And that's what I've done. Some of my partners are older, have families. So that means sometimes more on the ground responsibilities on me if something needs to happen. It's kind of on my boat and we get it done. So I really kind of turn the tables and almost use it as an advantage.
Yeah, no, that's great. And I think people should think about that because, sometimes just as a mental block, they may see their age as a limiting factor because they don't think people will take them seriously. But, results will always overshadow those preconceived notions. And then, like you said, taking something that may be perceived as a negative and turning it into a positive, that energy that you can bring to it, the focus that you can bring because you're not getting distracted by this or that. Those are definitely pluses. All right. Well, that was some great stuff. And we could obviously talk about that all day, but I want to move on to the turbo round. All right. So I'm going to ask you 3 questions in quick succession and just give me your honest answer for each of these. The first one is, what is the one red flag every investor should look out for? And that can be either a passive or active investor.
Underwriting and projection rates, right? When I review models, I always take a look at assumptions, especially growth assumptions like rent growth. That's the big one, especially the last couple of years that people have been a little loosey-loosey in my opinion. So really check the assumptions and those growth rates to make sure those are not driving returns on the bond hold.
Yeah, absolutely. And I think that should be like one of the top questions that people ask when they're looking at deals is, hey, what were your assumptions? First of all, they shouldn't have to ask the question because an operator should tell them up front what all their assumptions were. But if they fail to do that, definitely ask what their assumptions were and how they got to those numbers, right?
Yep.
And okay, second question. What is a myth about this business that you would like to set straight?
Don't chase cash flow. You see a lot of people, especially in Boston too, a lot of people that don't want to invest here are like, well, Boston's just too expensive. I'm going to go 2 hours south or 2 hours north to like New Hampshire or Rhode Island or even further south because I want to get better yield. But really understand what drives returns on the deal, right? Cash flow is great, right? And you certainly need it. I think it's a defensive mechanism, right? Because if you're not floating the deal, you're going to be buried pretty quickly. But that's not ultimately what drives returns. I mean, you can look at it financially, you plug it in an Excel sheet, and you look at IRR, average annual returns, all that stuff. They're very rarely driven by, can we squeeze a little bit more yield, right? It's typically market upside, equity upside. What can we do to the deal? Those are the big things that really drive returns. So really make sure you don't fall through that cash flow trap.
Yeah, I couldn't agree more. I think cash flow is a very overrated metric, but then again, it all comes down to what investors' goals are. If they are getting into a deal because they want and need to see that cash flow, well then, yeah, I guess find a deal that has huge cash flow. Me, I'd rather look for a deal that, doubles my money in 3 years than that gives me $1,000 a month. But again,
exactly. You got to put that in perspective, right? Like, is a couple $100 going to change your life? But if it is, that's good, and go invest in that. But if it's not, then play the longer term game, right? And understand really where the money is made on the back.
Exactly.
Yeah.
All right. And the final question: what does success look like to you?
Yeah, that's a good one. I'd say from kind of from two perspectives. From partnerships, the success to us is always, can we deliver results, right? And not only can we deliver results, but can we do it on a predictable and consistent basis over and over again? That's really what I'm building out today, and that's kind of really what drives me today is how do we create something that is able to not only just do one good deal here and there or, a handful of deals here and there, but how do we essentially create a machine, right? Where like, hey, we know this is going to deliver every single time. We've got the metrics, we've got the operations, we've got the criteria, we've got the system, like how do we create all that? So someone gives us $1 today, we know we're giving them whatever, $2.50 back in a couple of years.
Yeah, and that's a process that's never complete, right? It's continual and forever, because you can always make things just a little bit better, a little bit more efficient.
Exactly.
All right, Lior. Hey, this has been great. I think you've added a ton of value here, especially with your unique perspective, working from the Northeast with those more expensive properties. Please tell our guests how they can get a hold of you, and then if you have anything else that you'd like to share with them.
I'm very active on social media, so if you want to connect with me on Instagram or LinkedIn, I'm sure my profiles will be on there. I'm very responsive on those channels. And then the other is I do have a free ebook I like to give away. As I said, I started my professional career working in the corporate world. I did 2 years of management consulting. Even after I bought my first property, right, I noticed that working in that space, it's hard to like think for your own portfolio, right? You go into that space, you're working 60, 70, 80 hours per week. You don't really have time to like think of anything else, right? Like it's just, how do we do more work? So I created this book, especially for the busy corporate professionals there that are kind of in the weeds of like, how do we actually grow your portfolio? Doesn't mean you have to become an operator. There's obviously other ways of doing it. So hopefully that'll add value to people there.
Awesome. And we'll definitely have the link for that in the show notes. All right. Well, again, this has been great. I really appreciate you coming on and adding huge value to our audience. And I look forward to seeing you continue to do big things on your journey to multifamily millions.
Thanks for having me, Tim. This was awesome.
All right. Thank you.